Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today we're going to be looking at the definition of short, current, long-term debt. It's not as complex as it sounds. I'll give you the definition as I do in each one of these fundamental analysis tutorial videos, and then we'll look at an example and give you a little more insight. The short, current, long-term debt account on a company's balance sheet simply shows the portion of long-term debt that the company must pay back within the next 12 months. The short, current, long-term debt will be found on a company's balance sheet. For this example, we're looking at Walmart Stores Incorporated, the balance sheet. Moving on down here to the liabilities, the current liabilities section. Below there you will find a short, current, long-term debt. This sounds very complex, but it's actually quite simple. In many cases, when a company is paying back their debt, a portion of the principal becomes due within a certain particular year. Any portion of long-term debt that comes due in that particular 12 months then gets moved from the long-term debt category over here and then gets moved up into the short, current, long-term debt here, showing this is the portion of the long-term debt that is due now within the next 12 months and will be actually paid back. That's, again, anytime something's due within the next 12 months, it'll be listed under the current section of current liabilities in this particular case, or current assets in the other cases. Okay, so now you know it's very simple, very straightforward. The only item is you need to take note of is this does not include interest. Interest would be a completely different account, so it's important to note this is actual principal being paid back. In most cases, companies will be professional with their debt. They won't take on more long-term debt than they can handle. They only use it to improve their business structure and do wise decisions with it. On occasion, they do get in trouble and they do make stupid choices with their money. And that paying attention to the short, current, long-term debt is important. It shows the amount of that long-term debt that's coming due immediately or within the next 12 months. And you can spot problems if you receive, for example, in this case we have $6 billion for the next 12 months from this period. However, we also know, looking at the income statement, that we're looking at a net income of $15 billion. So in this particular case, it's not all that dramatic, but there are other cases where you will see it reversed. Maybe a company has $15 billion that are coming due, and then they're only getting net income from the same period of $6 billion. That would be a red flag if I've ever seen one. The company would have to deal with this cash flow problem that would be developing on their books. So that's one way of looking at the company's short, current, long-term debt. It's just comparing it to the earnings and make sure that they can actually handle the debt that they're going to have to be paying back, because eventually you have to pay back the debt. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.